Joining me is Brendan Ahern. He's the Chief Investment Officer of Chinese Internet ETF Kraneshares. Brendan, welcome. And again, this is something you guys have been working on for some time, right? Or is there a news element here that comes as a surprise?
Well, we're not surprised. For over a year, we felt that in order to find a solution in the Holding Foreign Companies Accountable Act, the main sticking point would be the 7 U.S. listed China ADRs that are also state-owned enterprises, that within that audit review, there's elements of potentially sensitive information, aspects about their ownership structure that the Chinese government likely doesn't want to hand over to the U.S. regulation. So we actually think that of the more than 270 stocks, that you have 5 Chinese SOEs delisting is actually a very strong positive to resolving HFCAA.
What about Alibaba?
I don't see Alibaba delisting from the United States. Yes, it is moving its primary listing to Hong Kong. But remember, that allows Alibaba to enter into the southbound stock connect, which means that investors in China, and Alibaba's got 1 billion users in China, haven't been able to buy the stock. So by going into this southbound stock connect program, Alibaba would see upwards of 20 billion of inflow. Tencent, 7% of its shares outstanding, almost 30 billion of market cap is held by investors in China. Alibaba wants that avenue, but I definitely don't believe they want to see their US ADR go away.
So why do you think that this is less of an impact than was previously expected? What does that tell you about relations between these two countries?
I mean, big picture politically, there's obviously a whole host of issues, and it's great to hear that, according to the Wall Street Journal, President Biden will meet President Xi later on this year. But I think this is a very solvable. HFCAA, the PCOB, these are global standards. The private companies have said numerous times that they have nothing to hide. There's nothing in the audit review would reveal user data or anything like that. The only companies that have something that they don't want to show the U.S. government would be the SOEs. So there's 2 SOEs that we anticipate will delist, and maybe that allows HFCAA finally to be the resolve, put to bed as it should be.
And then what? The whole issue is resolved? I mean, then what?
So the companies themselves have said many times that they want to adhere to this global standard, that they have nothing to hide from the PCOB. So in order to adhere to that standard, the PCOB has to be able to inspect the big 4 U.S. accounting firms in China. The Chinese law prevents that. And I think the reason for that is within these small number, only 7 SOEs across the 270 names, there's aspects about how they get subsidies or where their revenue comes about, that the Chinese government probably doesn't want to see. By allowing these SOEs to delist, that is a very strong indication that you might have a resolution coming. We're not there yet, obviously, and that's why we continue to take a conservative approach.
Do you think then the sort of frustration over Taiwan is blowing over for the time being? There was obviously a huge and furious reaction publicly by the Chinese. They suspended negotiations and relationships on a variety of bilateral issues. But now, to your point, we have this news about President Biden potentially meeting with Xi later this year. And the moves that you cite, I don't want to call them behind the scenes, but on a different level, suggesting there's still an obvious working relationship.
Yeah, I mean, I think, Kelly, we've spoken in the past that if you're really worried about U.S. China relations, you got to be worried about great U.S. multinationals that are doing great business in China, as well as global multinationals, right? Obviously, a company like Tesla, 25% of their revenues coming from China. Just this week, General Motors, their subsidiary in China, their joint partnership, outstanding sales in terms of electric vehicle sales in China, right? China's going to sell 6 million EVs this year, and GM is actually going to do really well there, not just Teslas. But there's a whole host of great U.S. companies that are doing business in China. Hopefully, the politicians can take a page from business people and try to solve some of these issues, right? China's not going away, nor is obviously the United States. Economies are very, very intertwined.
I guess a final comment to that would be, will the leadership there be able to keep China's economy dynamic enough to make sure that its stock investments are still attractive, especially given that tech has been the hottest sector, but there we've seen major clampdowns. What are your thoughts on the evolution of that policy, especially under another term of Xi's?
Yeah, it's certainly getting the companies within many of these internet companies we hold within KWeb were almost monopolistic, and we've seen those moats around their businesses go away. It's weighed very, very heavily on the sentiment the last year and a half. But we think on the China internet regulation, that issue is largely behind us. And it would just be great to see that this HFCA issue gets put to bed. We're not there yet. But within KWeb at a PE of 15, that's less than half of U.S. internet names. A lot of the names within KWeb are actually value stocks now. Both Alibaba and Baidu are top 10 holdings in MSCI emerging markets value. So I think some element of this growth comeback, U.S. tech comeback, that's left. We've lagged a bit there. But I certainly think a lot of the names we hold within KWeb are great companies taking advantage of the domestic consumption story in China at very, very cheap discounts.
All right, Brendan, thanks for your time today and for joining us. Brendan Ahern with Kraneshares.
Shepard Smith here. Thanks for watching CNBC on YouTube.